it's quite tepid if you look at the frontline index, still just meandering around that 18,000 mark. Nifty Bank is the culprit, down about 250 points. To the mid cap and the small cap index are up anywhere between 1 to a 1.25%. In fact, even if you look at the global markets, they are not very enthused. The Asian markets had held up in the green, but the European markets have started a tad bit mixed. It's just the German DAX which is holding up in the green, but the French CAC is down about 0.2%. And even in terms of the US futures, it's pretty much flat, not many cues coming in as far as the globe is concerned. Though oil has picked up a tad bit, it's now sitting at a level of $108 to the barrel. But talking about our own markets and in terms of the moodometer, our experts believe that for the Nifty, the consensus is a hold as of now. In fact, Nuresh maintains a hold on Nifty, as well as Kunal suggests to hold the positions at this point of time, though Rahul Sharma believes that there is still some steam left and he advises a buy when it comes to the Nifty. For the Bank Nifty, it's a consensus buy coming in. Nuresh thinks that most of the upside is behind us, and that is why he's suggesting a hold on Bank Nifty. But Kunal Bothra and Rahul Sharma are of the view that perhaps we can see some more upside as far as Bank Nifty is concerned, given the fact that it's come off the highs that we saw yesterday. So a fresh buy is something that they're suggesting. Let's take the discussion forward with Siddharth Vora, Head of Investment Strategy and Fund Manager, PMS at Prabhudas Lilladher. Hi Siddharth, thank you so much for joining us. The entire market setup seems to have moved on from the war fears and what was happening in terms of the yields and the expectations from the US Fed to now the Q4 earnings which are impending. What is your own expectation? Do you think, is the street expecting a lot and there is more room for the downside?
Thank you so much for having me firstly. I'll tell you my expectations. It's broadly divided across sectors and across themes. I think the bigger theme we see at a portfolio level is inflation proofing, making sure the sectors that we own have margin and pricing power. Other than that, we believe that a lot of margin compression could actually hit the street over the next 2 quarters, and one must look for pockets of valuation comfort and pricing power. And therefore, we believe dollar-denominated plays such as IT, specialized pharma, commodities could do better. And I don't think the street is overpricing expectations at this point.
Right. Siddharth, I also wanted to understand what's the expectation and the reading of the Q4 provisional numbers that we've seen so far, largely from within the financial universe, but they're indicating and hinting towards a very strong show. So,
financials, let's talk about private banks. I believe the credit cycle is very strong. Credit growth is very strong. The credit costs are coming down. And we do see an incremental expansion in ROAs and ROEs for the well-run private lenders in India. And we continue to stay neutral to positive on this space, selectively on certain banks.
Okay, so that's as far as the financial space is concerned. You are suggesting to perhaps look at some selective names. But overall, if you look at the economy, which are the sectors you think will outperform going forward? Because you talked about inflation proofing the portfolio, and that's not an easy job to do. Which are the sectors you think will likely hold out?
As I said, specialized pharmaceuticals, the likes of, say, Divi's, Gland, maybe domestic focused names like Abbott, IT, whether you're looking at mid-cap or large cap. Within the tier 1 and tier 2, we definitely see strong revenue momentum. Margins could cool off from the peaks of FY21, but we definitely see growth visibility for the medium term in IT. Other than that, we believe some component to metals and upstream commodities could add some defense to your portfolio. And we continue to remain bullish on communications, given the one-way market share consolidation, rising ARPUs, and strong subscriber addition for selective names. So those are some of the spaces we are very comfortable in terms of valuation, growth visibility, and pricing power.
Right. Siddharth, since it's in the news and we're still digging into the nitty-gritties, have to ask you, what is it that you made of the amalgamation of HDFC and HDFC Bank, and the kind of bearing as a mighty giant that it's going to have on the Nifty Bank's moves?
So there are two things. One is you look at it more fundamentally, and the other one is you look at it tactically. So from a fundamental standpoint, I think it's a mixed bag. We see a lot of strategic synergies in terms of unbanked customers of HDFC being an increased market for HDFC Bank. We also see credit costs coming down for the NBFC. We also see new branches being converted. So there are a lot of positives of this merger. At the same time, given the size of the two entities, ROEs and ROAs could come off, given that 11% mortgage is going to go to 33%, and therefore it could have an incremental pressure on ROAs going ahead. But tactically speaking, evaluating flows is going to be extremely important because the combined entity might have weights north of 12% at the index level. So how domestic flows shape up and how foreign flows shape up is going to be really interesting. But this will really keep the names active for some time to come. But structurally, it's a good thing. And if the view is very long, it's definitely something you must probably own in the portfolio.
Okay, so that's the word coming in on the HDFC twins and the proposed amalgamation and merger of the two entities. But since we're talking about the financial space, the big cue which is lined up this week is, of course, the RBI decision with respect to the MPC meet. What are you expecting? Do you expecting a stance change? Do you expect some rate hikes coming? What's exactly that you're building in at this point of time?
Okay. So currently, the way we are evaluating this situation is that post-pandemic, the growth has been strong for India. Now, given the war, the rising inflation, the rising crude, and the spillover supply side disruptions, we could see some disruption, not to the direction of growth, but to the quantum of growth. Given that, and inflation has already crossed the comfortable band of 6%, I think we could see some contractionary hawkish stance. It's just the timing that is really important, whether it's this quarter or the next. But I think incrementally, we don't see expansionary monetary regime to continue for too long from here on.
Sure. Okay. Siddharth, stay with us. Lots more.
Siddharth, we were talking about how the auto stocks are bucking the trend today, whether it's Tata Motors, Eicher Motors, they're all gaining ground. Would you say that there are still headwinds for this sector, or do you think most of the bad news is already priced in?
The way we are looking at autos is, so basically in the CV space, we do see strong demand and lower supply side disruptions with comfortable pricing power linked to the economic growth that we are seeing broadly, which is the infra-led economy, etc. Coming to passenger vehicles, we believe that the demand exists, but there are more supply side issues that are actually causing volume slowdown across the PV space. Two-wheelers is actually the space where we do see some pain in demand as such because of the rural slowdown in India. So given the three, the pecking order remains commercial vehicles, passenger vehicles, and passenger two-wheelers.
Right. Okay. Let's just take stock of some of the other buzzers in trade. And we've been seeing Havells hold out very smartly, Polycab, Metropolis, Dixon as well has now joined the list of movers. There's JK Cement as well, which is seeing a nice spike of about almost 6% coming in. But Siddharth, just wanted to understand, since, we are on the brink of the earnings season, where do you think that we'll see the maximum hit? And is it an obvious that it's going to be the consumption space at large because of the input cost pressures?
That looks like our first estimate also, whereby we believe staples and durables and discretionary, most of the consumers of commodities would see margin pressures. Staples are also seeing some headwinds in terms of volumes. And therefore, we are completely underweight on the staple space, slightly more positive on durables and discretionary, given at least there is volume and demand support in this space. Though our estimate is that the growth in discretionary and durables will be more price hike led rather than volume led. And we are positive on the summer product space where we believe the volume has also done well. And the price hike could support the overall revenue growth. But across the whole board, we do see margins being a challenge despite price hikes.
So that curious to understand where you stand when it comes to the entire
cement basket. What is the outlook in terms of expectations on volume growth, the overall demand supply situation, and how you're seeing the pricing scenario shaping up?
Looking at cement is volumes could be marginally down for the year. We'll definitely see some margin pressure. Despite price hikes, we do see some margin pressure. I think the space will only start becoming favorable post Q1 as the low base would create a favorable scenario for cement. But as of now, the way we are building in, it's probably earnings look weak, maybe 25-30% corrections could be seen. And we see that 50 to 60 rupees kind of increase in realizations looks likely. And the higher cost should negate this impact at a margin level. So overall, we're not extremely bullish on the cement space. We rather play a global commodity rather than a domestic commodity like cement. So, yeah.
Siddharth, I was going through the strategy note and I see a couple of these agrochemical names in your top bets, the names like Rallis, etc. And today as well, in fact, over the last couple of weeks, we have seen quite a bit of moves on all of these chemical companies, fertilizers companies. What's working in their favor? And given the up move, is there more steam left in these counters?
So I think the note you're probably referring to is the institutional desk note, and we are from the funds management team. But irrespective, we are positive on the energy and energy-related agro space. I believe margin pressures seem to be lower in this space. And we're also believing that rural demand could revive incrementally from here on with the monsoon setting in. And that's the reason I think we're bullish on the agrochemical space, at least the domestic place.
Siddharth, I don't know what's your opinion on power as a sector, and I don't even know if you track it that closely.
We don't really track power as a sector. We have had tactical positions in power at some points in the past, but not really big on the space as of now. But Tata Power, particularly with the move towards renewables, solars, and the overall product mix changing, and coupled with improving realizations, we believe it's probably well poised to do pretty okay going ahead.
Okay, that's the call coming in on Tata Powers right now. What else is holding out? Tata Motors, of course, is. There's ONGC as well, which is looking quite okay.